All right, today we're jumping into a real business mystery. It's a fantastic story about a successful juice company, a massive $5 million decision they had to make, and a pretty shocking discovery that was hiding deep inside their own numbers.
So let me just start with a question for you. Are you absolutely 100% certain that your fanciest, most expensive, premium product is actually your most profitable one? Because for the company in our story, the answer turned out to be a $1 million surprise.
So, let's meet our main character, BioFresh Juices. Now these guys are doing pretty well. They're at a crossroads, thinking about a 5 million ringgit expansion to build up their production capacity. I mean, this is a huge move, and everything has to be just right.
And at the heart of their business, you've got these two very different juices. First, there's the tropical blend, kind of the steady, reliable workhorse, Sells a ton of units at a pretty modest price. And then you have the premium detox. This is the flashy star, selling for more than double the price. On the surface, you'd think it's obvious which one's the real moneymaker.
Now, to figure out which juice was more profitable, BioFresh was using a really common method called traditional costing. It's super simple. You just take all your factory overhead costs, rent, utilities, the whole shebang, lump them all together, and then just spread them out like peanut butter across all your products, usually based on something simple like how many hours of labor each one takes. And, well, according to their official numbers, the story seemed crystal clear. The good old tropical blend was bringing in about 3 ringgit of profit per bottle. But the star, the premium detox, looked like it was bringing in a whopping 6 ringgit per unit. I mean, on paper, it's twice as profitable. So, case closed, right? Obviously, you just pour all your money into expanding the star product. But some of the managers at BioFresh, they just had this hunch, a feeling that something wasn't quite adding up. The numbers just felt, well, a little too simple. So they decide to bring in a new detective tool, activity-based costing, or ABC. Now, instead of spreading costs like peanut butter, ABC acts like a detective. It meticulously traces every single dollar of overhead back to the specific activity that actually caused it. Think of it like this. It's the difference between splitting a dinner bill evenly versus itemizing who actually ordered the expensive lobster.
So the investigation began, and they started by identifying what really drives the costs. So instead of one big overhead number, they broke it down. A machine setup for a new batch? Okay, that costs 2,000 ringgit. A quality inspection? That's another 2,000. ABC's job is to figure out exactly which product is triggering these activities.
And here is the first major clue. Get this. Even though BioFresh makes way less of the premium detox juice, it turned out to be a total resource hog. It demanded 1/3 of all the machine setups and a massive 40% of all the quality inspections. This premium product was secretly super high maintenance.
And right here, this is where the case breaks wide open. You see, the old method just kind of spread the costs around. But when ABC assigned the costs accurately, whoa, there was this huge, dramatic shift. A massive chunk of overhead cost moved away from the simple tropical blend and landed squarely on the shoulders of the complex premium detox.
And now, for the big reveal. The truth was pretty staggering. The tropical blend, it wasn't making 3 ringgit in profit. It was actually making RM 355. And the star product, the premium detox, its profit wasn't 6 ringgit, not even close. It was only RM 380. They weren't just a little off, they were dangerously wrong. The two products were practically neck and neck in profitability.
So what does this all mean? Well, the old simple system was basically punishing the efficient, high-volume product by piling costs onto it that it didn't even cause. And at the same time, it was giving a free pass to the complex, low-volume product that was secretly eating up all the company's resources.
And this changes everything. All of a sudden, that 5 million ringgit decision to expand production, it looks completely different. If they had gone ahead based on those old numbers, they could have poured millions into the wrong product.
To make the final call, they used one more tool, net present value, or NPV. The easiest way to think about it is this. Money you get in the future is worth less than money you have in your pocket today, right? Because of things like inflation and risk. NPV is this clever tool that calculates all the cash a project will make in the future, pulls it back to what it's worth today, and then subtracts what you paid for it. If the final number is positive, the investment is a go. So for BioFresh, it was pretty straightforward. They started with their 5.2 million ringgit investment.
Then they projected the cash they thought they'd earn from the expansion over the next 5 years. The really key step is applying what's called a discount rate, in this case 10%, which basically accounts for business risk. After that, you just see if the future cash you're getting is worth more than the cash you're spending today.
So what was the result? The NPV for the expansion came out to a positive 219,060 ringgit. On paper, that's a clear green light. It means the project is financially viable and should, in theory, make the company more valuable.
So they should just go ahead and write the check, right? Well, not so fast. This is exactly where our detective story and the financial math collide. Because a positive number, well, it doesn't always tell you the whole story.
And here is the absolute crucial risk. The entire NPV calculation, that positive number we just saw, was based on the old, totally flawed profit figures. It assumed the premium detox was a goldmine. If BioFresh had poured millions into expanding it, their actual returns would have been way, way lower than they predicted. They would have investing millions based on a lie their own accounting was telling them.
So what's the final verdict here? Well, it's a classic yes, but. Yes, go ahead with the expansion. That positive NPV is still a strong signal. But you absolutely must implement the ABC system immediately to track your real costs. You've got to rethink the price of that premium detox. It's costing you a lot more than you think. And maybe most importantly, you need to shift your focus to the real hero of this story, the reliable, truly profitable tropical blend. You know, this whole case really boils down to one incredibly powerful lesson. Making these huge, multi-million-dollar decisions, it's not just about having data. It's about having the right data. One simple flaw in how you see your own costs can send you down a completely wrong and very expensive path.
And that just leaves us with one final thought, really. BioFresh found this massive truth hiding in plain sight, in their own books. It really makes you wonder, what hidden costs, or maybe even hidden heroes, are just waiting to be discovered inside your own numbers?